Good morning, everybody. Peter Ciccone, Diner Discussions, February 5th, 2024. The new year's upon us, and we're back at the Dix Hills Diner. And I got a great guest today, Larry Just from American Capital Partners, right? ACP.
Yes, in Hopper.
And out here on Long Island, Hoppa, a few towns over. And Larry is, amongst other things, he's an investment advisor. But one of the great conversations I had with Larry, he called himself a stockbroker, and you were talking to me about what you look for in individual stocks when you look for them. You look for high earnings or good sales, and it was a fascinating conversation.
Well, that's what is called a fundamental analysis. When you look at the balance sheet and the income statement, I like companies that have a high profitability percentage on sales
High
and a
profitability.
lot of sales.
Okay, high profitability and a lot of sales. Amen to that,
they're
right?
doing something right. And then when you look at the balance sheet, I like a low debt to equity ratio adjusted for the cash. Because with the cash, they could pay off the debt.
Okay,
So those two criteria would separate.
what's a good balance? What's a good debt to equity ratio?
I don't know. Usually you go, people like a particular industry or they have knowledge of
Okay.
a particular company, which ones are well run, which ones are not well run.
Okay.
And I try to draw on their experience and then they get more involved in the selection.
What I've always, my understanding of investment was, I heard an analogy with football teams, believe it or not, where you look at certain coaches, Andy Reid or whomever, they always seem to win wherever they go. Bill Belichick, wherever he seems to go, he seems to win because he's a certain type of coach. He demands a certain style, a certain amount of play from his players. They have to live to a certain standard. It's the same thing in business where you're betting on the management team.
It's management, yes.
And,
the
you know,
success of the management.
Jack Welch, for instance, always seems to run a successful company because Jack Welch does things a certain way. It doesn't seem to matter what industry, he's Jack Welch. And when he's running the company, you're betting on him more than the company. And he'll bring the debt to equity ratio in line, and people will follow him because that's where the smart money goes. Is that a smart play
Well,
usually?
yeah, you see, in order to make money,
Okay.
the old-fashioned way, by not losing money.
Okay.
People invest in a concept that has no proven ability yet.
Okay.
And they have no profits, they have no sales even, and I would feel terrible if I put somebody into an investment like that and they lost money,
Okay.
So I wouldn't do it.
I see certain guys. Well, sometimes they want to catch lightning in a bottle. Will be the first one. I mean, there's the whole crypto industry right now, which I'm trying to figure out. I know there's technology behind it, but to me, at the moment, it's still numbers in a computer. And when people ask me, have I tried it? I tell them the truth. I've put what I call Vegas money in it. The same type of money that if I were going to Las Vegas with a friend, if I lost it, I would have had a good time, having a good time at a casino, but I wouldn't be crying in my suit because,
Well, it's no country behind it, so it's a currency without
it's
a
a
country.
it's a currency without a country.
And that
Okay.
is very risky to me.
It is.
I would like to stay away from risk as far as possible. But some people do time it right and they're successful, so you can't argue with that.
The only reason I have pursued it at all, even to the extent I have a friend who is who is an investment advisor, who got about a 7-figure pop in it. So he, in 2009 or 2013, way before the market went up, he put about $5,000 into it because he saw it as a hedge against inflation, a hedge against everything they say. And for him, it was almost a political move. He fancies himself with politics, he saw it as a forget the government type of thing. And he said, okay. And he threw $5,000 into it, made over $1 million. And so, let me be just a smidgen as fortunate as he, and I'll be happy. the ant can eat off of the other guy's crumbs, right? That's why I did it. But no, I understand what you're saying. But to me, it's still numbers in a computer, and I'm not.
Well, I also understand that when somebody tries to hack your computer and they want you to pay a ransom, they want to pay in Bitcoin.
They want to pay to Bitcoin.
So that's a bad,
Well, no, but
reference.
Bitcoin was, I think, is going to become. I think they're going to regulate it more. And again, you're not a crypto expert, but that gentleman is telling me he recommends anywhere from 1% to 5% of somebody's portfolio should be in crypto because he thinks it is the future and it's not going away. And I just thought that was interesting. I'm not there. I don't know if I agree with that, but he's not a risky type of guy, I don't think. He's looking at 15, 20 years down the line.
Even the countries have no hard currency behind their printing presses, they're
Okay.
printing out money. If you wanted to hedge 5%, you could put it in gold or silver
Okay.
and some precious metals that have never gone out of style.
Okay, so you're saying good old-fashioned gold or silver, precious metals is a safer bet.
Especially when we're facing risks, there's any number of potential wars we could be dragged into.
Okay.
There's a pandemic that might return, okay? There's an election coming, and
Yeah, they kind of mess with the economy once in a while, don't they?
monetary policy is one thing that you can track, but the fiscal policy is the real problem that's looming. because
What's the
we're-
difference between the monetary policy and the fiscal
So
policy?
the monetary policy is interest rates that they're trying to control the money supply. and
That's the Fed,
That's the Fed.
okay?
But the fiscal policy is the tax and spend,
Oh, the
if-
fiscal policy of the administration versus the Fed, which is supposed to be independent, blah, blah, blah.
One administration can come in and lower taxes, and the stock market can take off. Another administration can raise taxes and raise spending, and the stock market goes down.
Okay, but of late, if this administration has raised taxes, of late, the stock market's gone up, so how is that? How do you square that?
Well, politics aside, on election day night in 2016, when Trump was elected,
Yes,
the Dow Jones Industrial Average was under 20,000.
it's under 20,000,
Now it's almost,
almost 50, 38,
almost 40.
almost 40, okay.
So it's double.
The S&P is 40.
And it stayed high, and I really think that I'm not a single issue voter, but I believe in lower taxes. And I
Okay.
can get almost everybody to agree with me, because you can't get two people to agree on anything anymore.
Yeah,
When I
yeah.
say, I think taxes should be lower, everybody
Everybody
suddenly
agrees.
agrees with me.
I don't. You're more optimistic than I am. I think, oh, well, what do you mean? Anyway.
Well, I only met one person in my life who said, I think I should pay more, and I think he was lying.
Okay. No, and be that as it may, but so it has a direct correlation to how the stock market's doing. The taxes have a direct correlation.
I think so. I think people
Okay.
are more confident and they're more willing to invest in capital spending
Okay.
and businesses too.
Well-
Because one of the biggest expenses is taxes.
Okay.
Even individuals too.
So how do you advise then? Is a lot of your advice tax mitigation and how to avoid tax avoidance or tax?
The tax code is not very helpful. It's not really totally fair.
Okay.
In some cases, they want to tax your gains and they don't want to let you deduct the losses or spread it out over future years, $3,000 a year for whatever number of years it takes. I say, if you don't want to pay taxes, the oldest loophole is municipal bonds. Okay, they weren't paying much, but people want to beat the government out of the taxes, and this is a vehicle that works.
See, my theory with taxes is simple. If you're making the money, pay the taxes. And I understand what you're saying, well, then let me deduct the losses too. And when it comes to different styles of, do you trade? Are you a trader? Are you a buy and hold? How do you like to play the market? Any CPA will tell you, taxes are a cost of doing business. Well, that's the way I look at it. So if you made 10 grand and the tax is gonna be 3,000, it might be a lot. It might be saying that is a good chunk of change. You guys didn't do anything for the 3,000, but you made 10. You know, and if you calculate the 3, if you calculate some of the other stuff that's happening,
I'll give you a strategy that works. If you have a buy and hold strategy,
yeah,
and you pick the best companies, especially companies that do not pay a dividend. There's no dividend income, there's no income tax. If you buy and hold, there's no capital gain tax.
okay.
When you die, you leave it to your heirs, they get a step up in basis to the fair market value at the date of death, and it escapes taxation
So you
forever.
just leave it in the,
So you never pay tax at all.
you never paid tax. So you invest in a company that has no dividends. Okay, so you invest $1,000 in a company that has, or $1,000 in a company that has no dividends, and you hopefully over 20, 30, 40 years, it grows. Leave them that, because if you've not taken the money out, you've not gotten any dividends, the only thing that has happened is the stock value has gone up, and now hopefully your $1,000 after 30 years is worth $10,000, you know, or something of that nature.
Well, I don't know what the number is, but.
Well, I mean,
there
it's
was-
just hypothetical numbers.
There was a proposal in the recent past to tax the unrealized gains.
The unrealized gains.
Now, that to me is preposterous.
Well, nobody knows what it is, and they're gonna give the money back. Yeah, I think that guy was pretty well excoriated though at the moment.
I hope so.
And I think a lot of the times, and not to dwell on politics, the people, the donor class, won't stand for it because it's their money. They have a lot more to gain and lose when those laws get changed. You're not making the laws to protect me. They're not making the laws to protect you. They're making the laws to protect the billionaires. I mean, really, I mean, they're the ones that, you know, and that was one thing that Donald Trump said to Hillary Clinton. Well, you were in office for 30 years. I just took advantage. They asked him if he took advantage of the tax laws and didn't pay taxes. And he said, absolutely, that makes me smart. And he said, she's been in office for 30 years, didn't change the law. And she won't change the law because the laws we're talking about will affect all of her donors just the same way they'd affect me. And Dave Chappelle tells the story a lot better than I do. But that's the truth. The billionaires are the ones that are going to they make it for them more than they make it. And they're not going to change it because it would hurt them. Unrealized gains on $1.5 million investment is a lot more than on a $15,000 investment.
Compared to what? That's the question. I really think that taxes are important to try to avoid as far as possible.
As far as growth.
But as long as you follow the rules, and the rules keep changing, which is the risky part of doing taxes, because you have to be up on the code and the regs, the cases, case law, and I think it's a risky
So you
proposition.
like to avoid taxes for growth or in general or as a policy?
Well, it depends on the individual. Like I say, this is my observation that a lot of people left the IRS, and a lot of them were friends who knew what was going on, and a lot of the people who stayed are not as apt. And so I think the odds of being ordered right now are lower than it was in the past.
Yeah, but assuming, why is tax avoidance a good strategy other than to save money? That's a long-term growth strategy. Okay, so you're saying avoid the taxes to aid in long-term growth.
Yes, because what you keep is
What
what's
you
not
keep.
just what you made. Yeah.
Okay, and then when you retire or something of that nature,
Well, that's another story. As far as retiring, I don't think you should retire. I
Okay.
think if you retire, you might die. And if you don't die,
okay,
people come up to you and say hello, and you're stuck for an answer. So if you can keep going in a profession that you like
Okay.
and that you're able to do,
All right.
as you age, then it keeps you young. Actually, it keeps you functioning as an individual. And
Oh yeah, that's well, I know you know him. Dave Gusson and I were talking yesterday, and he said, do you plan on retiring? I'm only 56. I said no, not for any time soon. But if I'm working into my 70s, my 80s, I hope it's a choice. You know what I'm saying? I hope it's it's this or fishing, and I don't fish. I don't play golf, and just two things. Yeah, sitting on a boat for a few hours. I know it sounds lovely, except if you get seasick, then it's not fun.
what happened to me is my grandmother actually got me involved in the stock market.
Okay.
She opened up a brokerage account for me, and I was a newspaper boy.
Okay.
And I started following the market, and I looked at the financial statements that came. I looked at the auditor's opinion.
Okay.
I looked at the balance sheet, income statement, and the footnotes, and I learned a lot. I eventually went into finance.
Okay.
And I think that she was a big influence.
Okay.
And it's not the sweat of the brow type of earnings, but it is a skill. And,
Okay.
It can be very useful. I also I don't want to. My perception is, if you want to get the upside of the market, then you figure out what people need in terms of income. How much do they need to cover?
Okay.
And a lot of times the yield on the dividend paying stocks is not enough.
Sure.
So you can sell covered calls, which are a little risky, they're a little slippery like jellyfish. And you could lose speculative investment. But if you know what you're doing, it's really a conservative strategy. It's approved for retirement
So
accounts.
explain it. How does that work?
Well, you have the stock long in your portfolio.
Okay. What do you mean by long?
You own the stock.
You own a stock.
Right. And if you sell covered call, somebody pays a premium for that right to take the stock.
Okay.
But if it doesn't meet the striking price, then you keep the premium at the expiration.
Okay.
That increases your yield. Of course, if you're exercised, they'll force you to take a profit. But then you can buy it back again and you don't have to wait 30 days.
Okay. That's shorting, right? Or
No, it's not shorting because in shorting, your losses are theoretically unlimited.
okay.
So that's too risky. If you want to protect the downside, the upside down reverse strategy is buying put options on an index or something that correlates to your portfolio.
Okay.
And it works like an insurance.
And do you trade for certain people where you're kind of you're sort of playing the trend, and you're
Yeah, these are two strategies that work because they increase your yield
okay.
and they protect the downside,
Okay.
which almost everybody wants.
Sure.
And it seems to fit. The process is first you find out what it is that they want and what they can tolerate. Some people cannot tolerate a reduction of 10%. Some people cannot tolerate a reduction of 5%.
Okay.
That determines how you set the striking price.
Okay.
And then how
And does it
long.
also determine, do I do index funds with these guys, or do I like the purity? Somebody once told me he likes the purity of stock. So when he builds a portfolio, he likes individual stocks because it's more pure for him, and he's got a better sense of what can go up, what can go down, and he has his certain favorites.
I agree with that. I like to construct a portfolio, but based on the individual's experience and
Okay.
preferences, because they have knowledge about particular companies, particular industries, which ones are well run and which ones are not,
Okay.
and you can make money either way.
Sure, you make money. Okay.
And it helps them, when they're at cocktail parties and talking about which stocks they own, instead of some fund that they don't know more than the top 10% of the holdings,
Yeah.
that's not the same
Okay.
gratification.
But there's a certain stability with the index funds that I think a lot of people they don't have there. the roller coaster, if you will.
Well, the cost is probably less too.
Okay,
I think that's how they got popular,
okay,
when they were invented. Not too
all
long
right.
ago.
Yeah, they were all invented. I now I'm of the age where I remember all these things coming out and the index funds and there's so many different strategies out there, but we talked about taxes earlier. We talk about hiring a professional. I don't do my own taxes because I don't know as much as my CPA. I would never defend myself in court. Getting a investment advisor, and again I called him about something and we wound up talking. He had me more interested in what he was talking about because he referred to himself as a stockbroker. He said, I'm an old school stockbroker. And that was a guy who would call you up and try to sell you an individual stock. Hey, I've got this great product,
But we don't, we had options years ago, but we did not have the index.
Okay.
To correlate
And
the
then-
portfolio.
yeah, and I do something with my investment advisor. He's got the 401k stuff, and he manages that, and that's stuff I never want to go away. And if I die before I use it, it's for my family. And then I manage my own Schwab fund just to see how I do. And sometimes I pick up advice here and there from somebody, and I was somebody told me about NVIDIA about 6 months ago. About a year ago, I ignored it. Then about 3-4 months ago, he said it again, and I got it at one price, and now it went up. And
I had it 5 years ago, and I looked like a genius.
Yeah.
Because people held it, and it went up several times. It was like a 4-bagger, yeah.
yeah, 4-bagger.
You know what? A lot of people
That's a
assume-
home run for those of you who don't follow
A lot
baseball.
of advisors tell people that you should defer as much as possible. I would say just take the free money, get the match
Okay?
from your employer. But you think the tax rates are going to be lower in the future?
No.
Why defer it then?
Well, that's. I mean, in my case, that's a good point. If you don't think the tax rates are coming down, he's saying take the profit, take it now, pay these taxes in 2024 versus in 2044, or who knows?
We'll also develop a strategy that takes the money out of deferred into taxable, like paying the tax. If you want to reduce your portfolio 10% a year and go through the lower brackets, it's a strategy that works.
Why would you want to reduce your portfolio? To take money and to live on it?
You don't really have to reduce it.
Okay.
You have to move it.
Okay,
and pay the tax.
diversifying it. You're saying
No, you have to move it out of tax deferred.
out of tax
401k
deferred.
into your own account,
Okay.
and then you could have the same holdings even. You can buy
Okay.
it back. The fact is, you've paid the tax. Now, if you put it in a Roth, not only it comes out tax free, including the gain. The gain is not taxable.
Oh wow.
Yeah, it's an incredibly powerful tool that was invented in,
So
the
you're
Roth
saying-
came from Franklin National Bank.
If you take it out of your tax deferred account, 401k, and you put it into then your Roth,
Your own Roth.
but that's only the max $7,500 or whatever that is.
No, when you're taking it, when you're taking it out of a tax deferred account,
Yeah.
you can move I say move it gradually. But
Okay.
instead of doing it all at once, you don't want to run it through the higher tables.
Yeah.
But it's a strategy that works. It's a rollover.
It's a rollover. So you're rolling it over into another tax deferred account.
It's really a Roth is a hybrid,
Okay.
and it's a very powerful tool. And as long as you do it not all at once,
Okay.
I'd say adopt a strategy. If you want to do it over 5 years or 10 years, you take 20% or 10% a year and move it. That's my advice.
10% a year out of your 401k into your Roth
Right.
to avoid taxes.
Well, to pay the tax.
You pay the tax on the 10%.
Right, but then your holdings, realized gains come out tax-free.
Okay,
That's
now,
that's the benefit.
taking out of your 401k early, given my case, I'm not 65. Do I pay a higher percentage of tax because I'm not above the, I'm not 65?
Yeah, this is penalty.
There is a
I would
penalty.
wait, I would wait.
You wait till you're 65.
No, it's 59
59 and a half, or closer than I think. Okay. That's a good strategy.
That's a technical tax question, and
Okay.
it's very precise, but that's
59
one
and a
that has
half,
not changed.
okay.
That's- Or if you have a hardship reason,
Okay.
you can get a.
3 years. All right, we're getting there. All right. Larry, any bits of advice you want to leave the?
Well, you know, there's insurance protection, there's annuities, there's all kinds of retirement schemes
Okay.
that you can start taking in distributions.
How about overfunding a life insurance policy or something of that nature? Is
Life insurance is a very tax effective method of,
whole life
because it comes out
universal
tax-free.
life is
It
it
comes out tax-free.
Okay.
That's tax benefit. The only thing that we haven't touched on is estate planning, and it's very basic. Who gets what?
Okay.
When you're gone. You know, be clear and check your beneficiaries.
and for me, it's simple. You know, married for almost 30 years now. We're coming up on it. 29. We're coming up this year. My wife, my 2 children, and then it goes to my wife, and then then to my kids. 50-50. And what I would neither one of my children yet have children, but what I would have to change is that his half go to his children, her half go to her children, and that's it. But I spoke to somebody yesterday who he's married, but not to the mother of his children. It's a second marriage. And it's a sizable estate, and we were talking. We were just touching upon. And I knew I was going to have a conversation with you today, and we were joking, and he said, well, it would go to his wife, and I made a joke. I said, gee, that won't start any arguments with the family, will it? Can't see anything happening there. And he started laughing. He said, no, everybody, and he made everybody, he's got his children set up and his grandchildren and college funds and things of that nature. He's done that, but he was just talking about, he is 59 and a half, what he can take, what he can't take, and we're just having a different conversation.
There's 2 theories about that. One is, religiously giving the equal percentages.
Yeah.
The other theory is who needs it more, and then departing from that equal rule and favoring one over the other. I'm telling you, 2 different approaches. I'm not saying which is right.
No, and I'm not either. And that's a family, that's an individual decision. In my case, who needs it more? One's 24, one's 22. There's not really a difference. They're really at a very similar position in life, and it's not like one is a multi-millionaire with real estate holdings and investments, and the other one is a step above, getting kicked out of his apartment next month. It's not like that. A lot of times, though, you find the one who has done all the right things, and he is the more responsible, she is the more responsible one. So when you give more money to the other one, what are they going to do? They're going to go gamble it, or buy into a harebrained scheme of some sort. And if you guys have heard that, we were behind. Something's happening outside, and that noise has been playing. So thank you for paying attention, despite it. I know it was in my ear. Anyway.
Well, suppose one of the children was in a business and you invested in that business
Yeah.
for him, and then it would not be fair to the other siblings in a way.
Sure.
Be equal. It's just an adjustment that you could make.
I know one guy owns his own landscaping company, and his son-in-law works for him, and more than works for him, helps run the store, run everything, and runs a crew, and is very much involved. And when my friend plans to retire, he doesn't want to just sell to his son-in-law. he wants to give equal halves to his daughters, and have him run the one daughter's half. Yeah, that type of thing. If you want to buy out the other daughter, you have to buy it. You have to buy it from her. He doesn't want to just give it to one and not the other because he doesn't think that's fair. And part of it, I imagine, the son-in-law will have some work equity. Well, he's the smartest one to run it. It was his smartest choice to run it because he's essentially been doing it, and that's the plan to sustain the greatest amount of survival for the company. He knows the clientele, he knows the employees, he knows everything, and he's quality landscape. And
I'm not a lawyer and I'm not
Yeah.
practicing law without a license, but it's good to have a will, it's good to
Yeah.
have a healthcare proxy, and it's good to have these things in writing. And
yeah, everything in writing, just the plan. And then, like I said, I made a joke with the person I was talking to yesterday. Gee, that won't cause any problems. And he chuckled. He got it, but and he's close enough where I can make that joke. But that was what I thought. And he said no, he had planned. He has all the contingencies in there, and everybody will get their fair share. But she's his wife, and so this is also fair.
well, every case is different.
Yeah.
It's like a puzzle to be solved.
Yeah.
And if you find out what the situation is and what they want,
Yeah.
and just give it to them. It's a
Sure.
two-step process.
The two separate.
Then you never lose anybody either.
That's sales in a nutshell. That is sales. That is sales in a nutshell, and that's how it works. You ask them what they want, and if you can provide it, you do it. Now, sometimes they ask for things that aren't possible. And somebody told me about investing. You can make money in an up market. You can make money in a down market. The real trick, what the professional traders do, is they mitigate risk. They mitigate the losses. One thing I like to do if I'm in a stock, and I've been a big index guy for years, and I've been a big index guy for years, but I like individual stocks here and there. So if it goes up, I raise my strike price where I will sell it. Alert me if it's at 690. Alert me if it drops to 650. Especially if I bought it at 450. If I bought it something at $20 and it goes up to 40, hey, alert me at 35. That way, even if I sell at 35, I know I made money.
That's a stop order.
Yeah, that's a stop order.
And then you can be automatic. You don't have to get notified. It will automatically.
Just do it
So,
for you.
Yes.
Yeah, well, sometimes, and my problem has always been I don't like to sell the stock.
Well, good.
Yeah, but
It's a better long-term strategy.
it's a long-term strategy, but it hurt me too in the last couple of years when the market dropped from, near 42 back down to 30, and then I felt it hurt me because that part of my portfolio went down 20%, and just at this point in the last 6 months even, where it's going to come back to where it was, and I want to get better about taking some of the profit and maybe moving it, not keeping it per se, not spending it, but moving it to something else, but just sort of manage it better. I mean, it's a part of my income. It's a part of my.
Well, my motto is, this is America, land of competition.
The land of competition.
Why not try a test of a portion of your portfolio and see how I do compared to your other advisors?
That's the portion. So, any bits of advice you want to give the audience? It's been fascinating. I mean, I've been riveted by the conversation, despite the noise.
People say it's hard to tell the truth, but it separates people into two groups. One group that you can believe what they say, and the other group that you can't believe anything that they say. So I would just say, do something that you like and be honest, because it's a value. It's rare nowadays.
Well, I also, for investment advice, mine is, and I've gotten to this, if I don't understand it, don't invest in it, because you can't make intelligent decisions. And I'm not married to anyone's stock anymore. I'm not in love with him. I like him, but it's business, and business is a personal, and as much as it, you know, it's not. I mean, it's the old Godfather line. It's just it's not personal. It's business. And if I don't understand,
Leave the gun and take the cannoli.
yeah, leave the gun and take the canoe. That's even better advice. Larry, thank you very much.
You too.
Thank you.
Yes,
Bye, everybody.
hardest one.